Good morning, everyone. Welcome to Monday. Welcome to Monday Minutes. What a patriotic weekend we had behind us. Great weather here in New York as well. The one big, beautiful bill that was passed. Admittedly, we had doubts and questions whether it would get passed by that July 4th deadline. Not a question. We thought the bill would get passed, and certainly markets have been trading along the lines that this bill would ultimately get passed. Whether you like the content of the bill or not, it does notch some uncertainty away. If you look at the first 100 days of this administration, of the president's administration, filled with a lot of uncertainty, a market bottom in April, which we certainly wrote to our clients. We thought it felt emotional. It was the right time then to start scaling into risk assets. It's turned out to be an okay trade. We've come back quite a bit. When you look at these V-shaped recoveries in risk assets, typically they are followed historically by new highs, and that's what we're seeing now. So the one big beautiful bill is behind us. It is tariff week. Certainly negotiations are underway. Extensions are underway within limitations in terms of August 1st. Countries that are negotiating in good faith moving forward. A little bit of an extension there. The president has shown leeway along the way with regard to his policies, but he's certainly not backing away. You know, the tariff component of some of the uncertainty within the first 100 days will take more time to work itself out. With that, Friday, a decent employment report. If you look at the unemployment rate, which I think that is where the big question was, you know, unemployed going up, people dropping out of the workforce, jobs that are created in a very specific sector, again, the public sector, mainly state and locals. At the same time, private payrolls, less than expected. So, but nonetheless, look, this number is good enough, we think, to keep the Fed on hold for the summer. July certainly priced for very little, so we look towards September. In between now and then, we will get the July meeting. There will be signaling with that meeting. We do get the Fed's framework change, which will be front and center, the Jackson Hole confab. And then we're looking at the end of the summer to see where things shake out. And it will take more time. There are two sides to this coin with regard to the rate equation right now. Fed Chair Powell is saying if it weren't for tariffs, we'd be lowering rates. And the administration is certainly saying, look, we don't think tariffs are going to be inflationary. We think policies over time with regard to energy regulatory will actually keep inflation contained while producing growth. So it's a waiting game at this point. We need more time. We're going to need a couple more months to see how this data shakes out. Our own view in particular is that these tariffs will not be inflationary over time. It will be taken out more in terms of a growth story. But that's not where we're at here with policy in the U.S. You know, if you look at the rate structure right now, certainly nothing terribly wrong with this rate structure. You look at 10-year yields, you know, we got in and around 4.19. Our contention was the lower rate story here over time, given the current deficit levels, given the deficit levels that were likely to run in the near term, that the lower rate story going forward needs to be one of economic weakness. And we're not seeing that. And we're treading water here a little bit. You look at the ISM services number in and around 50. This economy is not booming by any stretch of the imagination, but it is plodding along. And we're not seeing that lower rate story to propel us to rates even lower from where we are right now. So we fall back within the range. But there's nothing wrong when you look at 10-year yields in and around 435, even 450, 4.25. There's nothing wrong with that rate structure. Both investors and issuers have become accustomed to a higher rate structure in general. Our deficit levels are still high. We still are floating a fair amount of debt. And we feel very convicted that if rates are going to move meaningfully lower from here, it needs to be one of economic weakness and a Fed-driven rate-lowering endeavor. Wishing everyone a great week ahead. There's really nothing on the docket this week to move the needle in terms of economic data or Fed speak. We'll get claims a little bit later in the week. We'll get the FOMC minutes, but this should be a pretty benign week in terms of rates. And long end supply, 10s and 30s, maybe a little concession and backup in yield heading into the supply later this week. Wishing everyone a great week ahead. I'm Greg Faranello. I'm head of US Rates for AmeriVet Securities.